Hello, everyone. This is Richard Amoido, co-founder of Investor Next Door Club. Welcome to our masterclass. Tonight, we're going to talk about creative financing, one of my favorite topics. I can't say it's my only favorite, but it's certainly probably top three. And it's probably one of those essential things that over time, as you start to understand it and learn it better, it opens up a lot of doors, and it pertains to more than just real estate. So, but we're going to frame it tonight around real estate because it's a easier concept to get around. So those of you feel free if you can drop questions in the chat as we go along. I'll look at them at towards the end. But it's open there for everyone to be able to drop comments or questions in. Happy to do that. Fantastic. All right, so tonight we're going to talk about creative financing in real estate. Three things that we're going to focus on, three areas or three types would be owner financing, asset-based lending, and private lending. And if all of those terms are completely foreign to you, you're by the end of this 30-minute session, you're probably going to know more than 92% of all the people out there in the marketplace because it helps so much. And listen, this doesn't just pertain to real estate investing. You could use this for your next home purchase. You could do this for your next, farm or compound or anything that you're buying that's got real estate associated with it. And people actually even use these strategies for buying businesses as well. So it's important to understand, have some of these fundamental principles, but most investors think they're locked out. They've been told the only way to get something done is to go through a bank. That door is hard and it kills a lot of deals. Usually the capital required, the money required is 25% down plus reserves. Banks, they're in the business of lending, but they don't want to take that property back. So they want to make sure they're not getting it back. They want to make sure you have a lot of skin in the game and a lot of risk. So that's why they go through heavy qualifying, looking at W-2s, your tax returns, looking at your debt to income ratios, things like this. And then there's the speed, right? Most banks move very, very slow. I've come across some that move a little quicker than others, but if they say 4 weeks, expect 6. And sometimes that could actually mean even 8 weeks. And when we're talking about commercial stuff, you're definitely looking at 60 days or more. And I've seen banks take as much as 120 days for a number of reasons. But creative financing solves a lot of this on the front end. Because remember, the important thing when it comes to real estate is you got to get control of that property. So as we go through this, what I want you to think of is I want you to think creative. And I want you to think combo. I want you to think combinations because these can get layered in. It's not just a one strategy, a one method to go ahead and approach it. Sometimes you can stack these things together. So the three tools we're going to talk about, the three sources of capital: owner financing, basically the seller becomes the bank; asset lending, asset-based lending. The property is really the reason what's qualifying it. It's not you. It's not your personal income. It's not your tax returns. It's none of that stuff. It's based on the property, based on the asset. And then there's private lending where individuals that are not party to the real estate basically act as your bank. They become your private banking. And there's just a lot of misconceptions when it comes to owner financing. I've been in the world of raising capital for 20 years now. And, a lot of times people think, well, you can't raise money or you can't do this type of financing unless you've got a license or this, that, and the other. And it's just false. Now, there's ways to do it that's wrong and actually even illegal, but we're not talking about those ways. We're talking about things that get done in a very ethical, moral manner that meet all the guidelines. So let's kind of talk about how the deal is structured. When you're, looking at this private lending, the seller financing part, the seller is going to act as the lender. You sign a promissory note and a mortgage to the seller to pay them back directly. There's no bank involved, right? You qualify on the property and the relationship, not tax returns, not credit score. None of those things apply. Now, you could look at a couple of different scenarios. where your seller, the seller financing, the seller of the property, maybe they take 5%, maybe they want 20%, maybe they want 10%. All of it's negotiable. The thing to remember when it comes to seller financing is you're looking at coming to an agreement on price and terms. Sometimes a seller wants a price, but if they want that price, then they got to accept my terms. And that becomes part of the negotiation. So this is where knowledge and confidence comes into play. There's only a couple of ways to get knowledge and a couple of ways to get confidence, and they're usually a combination of learning, taking action, and having some wins, and that's going to build your confidence. But the other thing that's really attractive about seller financing is the interest rate is often either at market or below market. So if you look at where interest rates are now, depending if you're looking at residential, you're looking at commercial, you can see stuff in the high fives, the sixes. You can see stuff in even still in the sixes and sevens, depending on what type of asset it is or types of deal. But nonetheless, you could get sellers that will be market or below market for a number of reasons. We'll talk about some of those in a minute. The terms, it could be the payments get amortized just like a bank loan, 30 years, but usually there's going to be a balloon payment, right? The seller doesn't want to carry you for 30 years. If you're selling to somebody who's 60 years old, they may not want the final payment to be when they're 90, unless they're planning on leaving it in a trust or for their kids and whatever, their grandkids, whatever it might be. But typically, when you have a seller finance deal, it's going to be the payments are going to be divided up over 30 years, and then you're going to have a somewhere between 3, 5, maybe even a 10-year balloon note where they want to be fully exited out of that. The documents that are used is going to be a promissory note, mortgage, and a deed of trust. All of those are going to get handled through a title company. I personally have never done, I've heard of people doing it. I don't recommend it, closing a seller finance deal without a title company. And the reason why is a title company has a lot more resources to verify chain of ownership, even be able to see the survey and making sure that everything that you expect to be true is actually true. Because when you become the owner of that deal, you want to make sure you are actually the owner of that, and they have insurance to protect if they did anything wrong in the transaction. So it's kind of like when, it's been a while since I've been to Vegas, but I do know that when the dealer flips over an ace, they ask if you want to buy insurance. Usually it's a good idea to buy the insurance. So title company is your insurance in that transaction to make sure it goes from this owner to this owner, and there's no question about it. So that's why you use that. But when this works and why a seller agrees is primarily the property's free and clear. Now, I know of people that do things that do subject to the existing mortgage, and that can have a lot of constraints to it. And every state's different. Every lender is going to look at that differently. Sometimes they never even know it happened. But just know that there's always a little bit of risk when you've got an underlying mortgage. So this is best. You're going to get the most flexible terms that you're looking for and probably the price that you can live with when the property is free and clear. Now, here it is. You've got maybe tired landlords. You've got inherited property. You've got motivated sellers. They're looking for, how do I get this off my plate? I didn't intend to own this. I don't like owning it anymore. There are a lot of owners that are asleep at the wheel and they're looking for someone else to take it over, but they don't necessarily want all the money right now up front. And then this is properties that banks won't touch for a number of reasons. Could be cosmetic, could be structural, could be foundation issues, could be too niche or too hard of a property for a bank to resell that they don't really have a market for. Maybe it's too rural. And so it's got to be a private, it's got to be, some kind of owner finance type situation. This is where you've got, self-employed buyers, a lot of real estate investors or even part-time real estate investors, they don't have the W-2 to support to go do something, right? Their W-2 is not going to support it. Maybe their credit score's not great. Maybe they don't have enough reserves to get qualified. So this is where none of that stuff comes into play. It's just you working it out with the owner, with the seller, and you come up with a price and terms that everyone can live with and move on down the road. And yeah, you're going to put a little skin in the game, but also you're going to be using the profits from that property to pay that thing off as well, assuming it's an income producing property, which I highly recommend. Now, why sellers say yes? One, typically they do get a higher price. And the reason why is because they've agreed to your terms, therefore you got to agree to their price. Now, sometimes that can go a couple of different ways, but just know that it becomes more attractive to a seller when they can get a higher price, especially if something's been on the market for a while or it's just too niche, it's too rare, but it's perfect for you. That's fine. Don't ever tell a seller that something's perfect for you, right? Always let them think that there's something that you don't like about it, but you're willing to kind of work through it. It's kind of like going to a used car lot. Don't ever tell the sales guy, "Oh, this car is perfect. This is the perfect color. My wife would love this." Don't do that. You have completely shown your cards completely, and now you've got no leverage in the deal. Sellers also like the idea of getting a steady monthly income. If they're approaching where they really want to retire and kick back, and they're like, okay, I could get all this money up front. Now I got to go redeploy this money into something. Do I go put it in CDs? Do I go put it in a money market account? Do I put it in the S&P 500? Whatever. And sometimes we're like, I'd just rather get the cash flow coming off the property, because the worst case scenario is I take the property back and I have to foreclose on it. And that's their collateral, is the property they once owned, and they know they could sell it again because they sold it once. So that becomes a really attractive for the seller. The other thing is, you get to use, like I said, those capital gains across those years to make all those installment payments that you're going to do. Also, for a seller, it widens their buyer pool. If your buyer pool has to be someone that qualifies with credit and cash, well, that's going to narrow the audience of who can actually buy that. So bottom line is, these offers, they tend to get more of them, and they tend to sell a lot faster as well, because it's non-bank. It's a non-bank transaction. They know they can move faster than a bank can. Now we're going to use this a duplex example with no bank. So let's say there's a purchase price of 400. The seller owns it outright. You give them 10%. You agree to a 6.5% interest rate and a 7-year balloon note. Now, meanwhile, the mortgage payment is factored over a 30-year period. But when you get to year 7, you're going to have to refinance out of that, or you're going to have to sell it, because they're going to need 100% of all their money by year 7. So you got a lot of time to figure out things, get it cash flowing, doing what you're doing, maybe appreciate it, increase the value, do a cash out refi, or just do a regular refi, or sell it, because now it's appreciated higher than what you bought it for, and you're going to turn it over to someone else and go put that in a better deal. Now, if you do this with a conventional bank, you might be putting 100,000. Now, there's programs out there where you could reduce that a little bit, but owner financing is going to allow you to come to the table most of the time with the least amount of money. And it's going to allow you to have more money in your pocket, and whether you make the property better or you just have reserves. So it just gives you a lot more options to control your cash and not tie it up in an illiquid asset. Now, asset-based lending, that was my first fund that I had for a number of years, which I love doing, because you get to move really quick with this. Now, as an asset lender, it's got some very good returns as well. But for the real estate investor, it provides a lot of options. Speed to market, speed to a transaction is super critical. So, a couple of things to look at here. Now, we could spend several hours just talking about creative financing. We could spend days. So I'm going to talk about these 3 things that are kind of like strong categories for these things. For long-term holds, one option is a debt service coverage ratio, a DSCR. Now, why this is a relatively new product to the marketplace. Why it's called part of asset lending is because it's typically based on the property, but mostly based on the lease that's in place, lease or leases, because you could have multiple, like in a fourplex or a multifamily where you've got 50 to 100 units, whatever. But they look at that as, okay, will this debt service, can these leases cover this ratio? Usually they're looking for a 1.25, where you've got at least 25% more in excess after you pay off, after you're paying off your mortgage and everything to operate. So the great thing about this is they're looking at the property, because they want to make sure it's in decent shape or good shape. And then they're looking at the value of the leases. And this doesn't involve your tax returns. They might look at credit score. They might want to see a principal that's got a good credit score, credit rating, whatever, but it simplifies a lot of things on the qualification piece. Then there's hard money, which my asset fund did a lot of hard money and a lot of bridge financing. This is great for a fix and flip. This is usually great for a quick turn or some kind of transition. I'm kind of lumping these together. They're similar, but they are still different. Hard money can come from an individual. Hard money can come from a more formalized firm or institution. Bridge is usually going to come from some bigger players. But all of these are done to mitigate not having the cash reserves, not having the credit score, not having the W-2s, not having the tax returns. It is just based on the asset and how it's going to perform over time. So there's a reason and a season doing these, but all of my investors that we were financing and funding, and we would do it very, very quickly, usually 7 to 14 days, they knew that they could put something under contract, put a little earnest money down, and as long as that value was there and they were buying it at a discount, then we could move very quickly and help them take that down. And then usually 90 days, maybe 6 months, they're exiting that, either selling it or they're moving into a more permanent type of financing. Maybe they move it into a DSCR, maybe they move it into some other rate term, but nonetheless, it allows them speed to market. Now, the speed and flexibility I've talked a lot about, and just makes sense for them to do this. When you're looking at, a deal that is falling under the categories we just talked about, credit score does become a little bit of a factor. The asset is a major, major factor. And just the speed to close is usually going to be, let's say, 1 to 4 weeks. But I would say most of the time, if you're with a good shop or a good lender, you could get it done in 2 weeks. That would be a good time frame to work with. The hard part about all of these is making sure you have all your ducks in a row, making sure you have all your paperwork in a row. And we're not going to go into all the doc prep and things that happen along the way. But you know what? Waiting on one doc could chew up 2, 3 days, right? And there might be a special request that comes in that could chew up another 2 days. So it doesn't take long really to approve something and fund something. It takes a lot to fill in the gap between those things. So just consider that over time. You are going to pay a little bit more of a premium on these asset-based type loans, but nonetheless, it becomes an option, especially when seller financing is not available. Let's talk about private lending. Private lending is a lot of fun because it can involve a lot of people in your community. It can involve friends, it can involve family. It cannot involve strangers, and we're going to talk about a little bit why. And if you've been on some of our other ones where we talk about securities, you have to understand the SEC spends more time going after non-publicly traded operations than publicly traded. So just because it's private does not mean that it's immune from all the public securities that are out there, because securities are securities. They do not care if it's public or a private transaction. Now, where the capital actually lives with these private people, now you could have people that have friends and family and network that they've got money, maybe they've got in savings, maybe they've got money tied up in IRAs or some kind of solo 401k, or someone that is just looking for a higher yield than what they were getting in the market. And most of the time, you can think of it, they're going to be getting somewhere between 10, 12, they could even be getting on upwards to 16% return, depending on the time frame or how the deal is structured. And you've got to kind of figure out how all that math works to make sure your deal is able to survive and go through the transition that it's in. But if we look at the deal anatomy of a private lending type situation, they're going to take a first lien to the property. I haven't seen anyone take a second lien, but they're going to take a first lien. So their collateral is the property. You're borrowing the money from them unless you're bringing them in as a partner. Okay. And we'll talk a little bit about that in a minute. It's going to be a short-term loan most times. If it's going to be like they're kind of being the pseudo bridge lender or asset-based lender because they don't want to be in it too long, then you might be in a 6-month thing. Maybe they say, hey, listen, I'm good with being in this for 5 years. Whatever makes sense. It all becomes down to the relationship and their confidence in the deal. There's a lot of value in you finding a deal because they're wanting to get a certain return. You've got a deal. That's a potentially good marriage. So great deals, good deals, they don't come around all the time. So when they see something, it's like, great, I could tie my money to a market that I don't control, or I can tie my money to a hard asset that I know I'm not going to lose my principal on. So that's where it makes sense. So they can typically get a much better, rate than they're going to get in obviously a CD or a money market. S&P some years just depends on how it's doing, but let's just say they're getting somewhere between 8 and 12% return. That's a good return. And especially when it's collateralized, right? They've got a real chunk of collateral. Now, typically they're probably not doing 100% financing. So you got to be prepared for some capital being brought to the game. And they could be taking a first, they could be taking a second lien. Let's say that first lien is coming in from an asset-based lender. Well, that asset-based lender may not allow a second lien. So you got to find out if that's even remotely allowed. If you're bringing a private lender in to cover a gap that the asset lender's not covering, then you got to work that out ahead of time. You don't want to try to figure that out at the closing table because your deal's going to die. But keep in mind, it doesn't matter. The first lien is always going to have superiority, and in the event of a foreclosure or default, they're going to win the game every time. So it's just the second lien holder gets what's left over. So most private lenders don't want to be behind a bank because it does get a little sketchy sometimes. Now, I'll always like to create a win-win scenario. Let's say it's a family member. Let's say they got money sitting in an IRA. They've been putting money in for decades and they got 150K sitting in there. Maybe it's only earning like 4% right now. Well, they get this new yield where they're getting 9%. They pick up 13,500 for the year going into their IRA tax-free. Not a bad deal. And they get to grow that over time, and they can do that multiple times. So you're the borrower and you've got an 18-month hold. They're going to be picking up 9% interest for 18 months, 9% the first year, and then they're picking up 4.5% for the second half, right, of the year. And so this becomes a really good win-win. And there's a lot of people out there. If you'll start talking how people want to be involved in real estate, you're going to find out a lot of people have questions or they're really curious. That a lot of them think they're locked out. They just don't know how to get in. That's why having a community like Investor Next Door Club kind of meets that gap. It exposes what's actually possible. We open doors that people didn't know they could actually open. So this is why it's really critical. Now, you want to stay on the right side of the line. And I've had two real estate funds. We just formed a brand new fund that's a crowd fund that is actually registered with the SEC. So we've gone through a lot of scrutiny over the years to make sure we understand how to raise capital properly in different types of structures. I've done it privately that required no securities work. I've done it a lot where it's required a lot of securities work. So when you're borrowing from people that are in your existing relationships, this is generally fine. But soliciting strangers is a major no-no. You've got to have some kind of relationship. This isn't someone you met at a networking party. This isn't somebody that you just someone introduced you to somebody. You got to make sure you kind of build up that relationship. And depending on how the money or the instruments that are going to be used is going to really determine have you crossed the line or yet. So just remember, pre-existing relationships is your safest, most straightforward way, especially on a private loan. Soliciting unknown investors. Now we're walking into security territory where Reg D or Reg CF needs to come into place. Those are exemptions that the SEC allows operators like myself to utilize to do things in a compliant manner. And then when you're in doubt, definitely talk to experienced people and or talk to securities counsel. Listen, if you talk to someone that you've got a lot of confidence in, don't let them give you legal advice, but at least let them give you the lay of the land of where you understand where the black line is and when you've crossed over in the gray or you've crossed completely off the edge. Some things are really obvious, and somebody with experience will say, you know what, this is what I'll tell you, but I would recommend that you have an introductory conversation with this counsel just to make sure you're on the safe side. So don't take free legal experience as legal advice is my best advice to you. As someone who's not an attorney and someone who's not a CPA, just make sure you always check on those things. We've spent hundreds of thousands of dollars over the years with counsel, and there's a lot I know, but there's a lot that changes from year to year sometimes, and it's important. So if we look at a side-by-side comparison, right, just choosing the right tool, and remember, you got to think creative, you got to think combo. And owner financing, we've got the seller, and then it's all based on the relationship and the property. then it's typically a rate that could be below market or right at market. It's either is fine by me. Obviously, I always want to get lower. You can move very quickly, 2 to 4 weeks. And that just depends on the speed of how two people are working together and the title company and so forth. Best when the property is free and clear and you've got a motivated seller. Motivation comes from a lot of ways. It could come from a spouse that says, I want to get rid of this. It could come from, I just inherited this. I don't know what to do with it. It could be, I want to retire and I just want to get my cash payment plus my Social Security, whatever. But you're looking for whatever that motivation might be. And then the biggest risk is there's going to be a balloon finance of some sort. There's going to be a day where you got to pay that thing off and it's not going to be 30 years. It's going to be, it could be a couple of years. It could be 10 years, but you're probably not stretching it out too much further than that in most scenarios. Asset-based lending, this is going to be someone that's a little bit more institutionalized. Could be a small fund, could be a large fund. The asset itself is really the crux to the whole deal because that's where their collateral is. They're not going to do 100% financing in most cases unless you're buying something deeply discounted. The rate you're looking at 1 to 4% higher than the market rate, most cases. Could be even higher than 4% from there. But just know that you use this because you're trying to move with speed and you're trying to move with some sense of confidence that you can get to that next phase. Typically 1 to 4 weeks. It's perfect for self-employed people. This BRRRR, if you don't know what this is, buy, rehab, rent, refinance, and then repeat. Okay, this is a great method to, if you're going to move quickly. You don't want to sit on asset-based lending for too long because it can really, really chew up your cash flow. Then when it comes to private lending, you're dealing with an individual. You could be dealing with individuals. That's where you got to be really cautious on the paperwork that you're using. This is a lot based on trust. It's based on relationship and it's based on the collateral. The deal's got to make sense to them also. I've seen a lot of people that were first-time private lenders and they had no clue what they were going to be doing in retirement. And now this is all they do is private lending. They do somewhere between 1 to 6 deals a year and they love the returns they get. So they turn it into a little passive business for themselves. Days to 2 weeks to closing. You can move very quickly with a private lender because you're not dealing with an institution. So you got speed, flexibility, build a strong network because there's only a certain amount of capital someone has. And if you only got one trough to go to, well, then that capital could be tied up. So you want to be developing these relationships and talking with people that you know and getting to know people that they know. And it's good. You'll find over time, you've got 10, 15, 20 different people that you can go to when you have a deal that are willing to be a private lender for you. It's a great win-win relationship. So make sure you got the relationship and you button up the compliance. So 3 questions that kind of filter on some things. Question 1, who has the leverage? If the seller is motivated and the property is free and clear, start with owner financing. Throw it out there. It's not going to make you look amateurish. It's not going to make you look desperate. I thought in the beginning it was going to make me look weak. But if you're having enough conversation and dialogue with someone, you're going to find out reasons why they may want to. And sometimes there could be a tax reason. Sometimes it could be they just don't want all that capital right now. And they like the idea. Some of it is, well, they think, well, I want to sell this, but if I had to get it back, it wouldn't be such a bad thing. So just know there's a lot of different motivations at play. And then looking at what's my exit and when? Is this a long-term hold? You're going to go into something that's a little bit more permanent, like a DSCR type loan. Are you looking to create some short-term value, add it, and then sell it off? Consider these options because the higher your interest rate is, depending on what route you go, it's going to chew up your profit. It's going to chew up your cash flow. It's going to chew up your profit. So you gotta do the math on this. You can't just go, well, I can take it down. That's great. Now, how are you going to make sure it's profitable? Because when you buy in real estate, you buy knowing what your profit's going to be when you exit. Whether that exit is in 6 months or that exit is in 6 years, you know what your minimum profit's going to be. Now, you might add more profit to the deal, but you certainly don't want to give up the profit that you know you're taking it down for. And then whose money is closest? If a private lender in your network can fund this week, great. Use them and refinance it later. Because what sellers like is they do like to be able to get money quickly. Now, whether that's a little bit of money or a lot of money, That's between you and the seller to work out. But here's a couple things to kind of consider is what's the most common mistakes do investors make with owner financing? Well, like I said before, they start to think, well, I'm going to look weak. I'm going to look like an amateur. And that's just the furthest thing from the truth. Now, I've had people get insulted. Don't get me wrong. Someone's a, I'm not owner financing. I want someone that is qualified. What is this? I didn't say I wasn't qualified. I'm just looking for the best terms I can have to make sure I can get you the price that you're looking for. Now we start talking on a level playing field. How do you find private lenders without violating securities laws and rules? Well, one, you get to know people. It's not a guy you met yesterday, unless they're already a private lender and that's their book of business. But if we're talking about someone that is not a private lender and we're looking at turning them into a private lender, you're going to want to have a little bit of dialogue because you don't want to get in that entanglement. And you do need to make sure that you are working with an attorney. Even if it's not a securities attorney, you do want to make sure you're working with an attorney to make sure that you're a real estate attorney to make sure you're at least covered on the proper paperwork if there's no concern at all that any securities laws are being violated. And when does asset-based lending stop making sense on a rental? Most of the time, you're looking to get out of asset-based lending pretty quickly because you don't want to be chewing up your cash flow. And depending on, we're not talking about single family that you're looking at on rental, right? We always talk about having multiple units of some degree, but yes, you could take down a fix and flip with an asset-based loan, a hard money loan. You could do that, but you need to be thinking speed. Like I got to get out of this quickly because this is just for me to take it down, rehab it, and get it on the market and get out from underneath that high interest rate. So only usually works when you've got something that's deeply discounted. Let me just see if there's any things in the chat here. Um, Clearly a lot of experience poured into this. Yes, thank you. I appreciate that, Mario. It's hard to compress a lot in 30 minutes. This is why we do the deep dives and give you guys a chance to ask more questions. You know, you can always submit questions to support at Investor Next Door Club. Sandy can drop that in there. You know, more is caught than taught. And this is why being a part of a community where, you know, when we do our social events or our gatherings or any kind of online gathering that we do, never hesitate asking a question. There is no dumb questions. There's questions you don't have experience with. There's information you don't know about. There is strategies and there's new strategies being created all the different time, but there's the basics. And at Investor Next Door Club, our job is to try to help you guys, you know, get comfortable with having the conversations. You know, I don't believe in the weekend warrior events where someone goes and they're like, all right, I'm going to go. I got all this information over, you know, 10, 12, 16 hours, whatever it is. And you're ready to go run through a brick wall. And problem is when you run into a brick wall, the brick wall usually wins. So it is important to be around a group of people that are learning together, that have experience, that can even help you craft some of those deals because we were fortunate early on, 20 some odd years ago, where we had some really good mentors that showed us the ropes. And yeah, we've done all of the big high ticket stuff because for the networking purposes, but also just staying in the know and just listening for new things. But that's why we created Investor Next Door Club, where people could start at a place that made sense for their lifestyle they have now because most people aren't looking to become full-time real estate investors tomorrow. Maybe not even at all. You know, you can be a real estate operator, you could be a passive real estate investor. The main thing is how do you want to make money from real estate? And you got to figure that out. And it's not because someone taught you one strategy, one technique and that's all you ever learn because that will not work and survive in every season. There's trends, there's seasons, there's different asset classes. And what we try to do is give you that breath, right? To where you can start to explore without risking tens of thousands of dollars and not getting a return on it very quickly. So that's why we have a low subscription cost to our club. Feel free to submit any questions, any comments. If there's things that you want us to talk about because you heard it somewhere on social media, you heard someone talking about it at a party, don't hesitate to make suggestions. We are here to curate and support where you guys are at. And the only way for us to know that is by you letting us know. So I appreciate your time. Look forward to working with you. And as always, we love being on the journey with you. Talk soon. Bye-bye.